Stocks are swinging, savings are shrinking, and prices are climbing. But the biggest risk? Doing nothing. That's what leaves people broke when the dust settles. In this video, I will show you how to take control of your money while everyone else freezes. Hi, I am Zara. I make money simple so you can take control of yours. Let's start with what is causing it, and then I will show you exactly how to protect your money. 1. What is actually causing the crash? The market is down sharply, and it's not just one reason. Inflation has stuck around longer than expected. That means everything from gas to groceries still costs more. And the Federal Reserve is trying to cool it down by raising interest rates. Higher interest rates mean it costs more to borrow money. That affects businesses, houses, student loans, and consumer spending. As a result, companies slow down hiring and start laying people off. Growth slows, and when the growth slows down, investors start pulling out their money out of the market. Now add uncertainty on top of that. War, supply chain issues, tech layoffs, political division, global instability, and the market reacts the same way every time. It sells off. And it's not because anything broke overnight, it's because people feel uncertain, and uncertainty leads to fear, and fear that moves the market faster than anything else. Number 2, why this feels so personal. You might be thinking, okay, I get the causes, but why does this feel so different, so emotional? Because money is emotional. We don't invest just for fun. We invest to protect our future. So when the numbers start falling, it feels like you're losing control over your life. Your brain reacts like you're in danger. That's not your fault. It's how we are wired. And when we see our money disappear, our instinct is to protect what is left. That's why the most common reaction during a crash is to sell. But that instinct is usually wrong. Because selling in a panic means locking in your losses. It turns paper losses into real ones, and it almost always means missing the recovery when things turn around. This emotional loop, fear, sell, regret, is the biggest reason why most people underperform the market. Number 3. What history actually shows. Now, let's look at the data. This isn't the first crash, and it won't be the last one. Even go back to 1929, the Great Depression. Then we had Black Monday in 1987, about 23%, and the dot-com burst in 2000. Every single crash has been followed by recovery, not immediately, not easily, but consistently. In 2008, the market fell over 50%. It felt like the world was ending. Banks failed, people lost their homes, and everyone was terrified. But investors who held on or even bought more ended up with massive gains over the next decade. From the bottom of 2009 to the peak before the pandemic, the S&P returned over 400%. In 2020, the market dropped 34% in one single month during the pandemic. People said the economy will take years to recover, but within 6 months, the market had fully rebounded. A year later, it was all-time highs. The pattern is simple: short-term pain, long-term gain if you just stay in. Number 4, the mistake you must avoid. This is where most people go wrong. They try to outsmart the market. They try to time the bottom, or they chase trends. Jump into risky assets or pull out completely to wait until it's safe. But here is the truth. The market never feels safe at the bottom, and that's what makes it the bottom. But every time it feels safe, prices are already higher. You miss the dip, you miss the recovery, and you buy back in too late, and you end up chasing the cycle of reverse. The cost of missing just the 10 best days in the market over the 20 years, you cut your gains in half. And those best days usually come right after the worst ones. That's why trying to time the market isn't just hard, it's dangerous. Number 5, the psychology of fear and herd mentality. We are social creatures. When we see other people panic, we feel the urge to do the same, even if we don't understand what is happening. This is called herd behavior. It's why market crashes often accelerate. Everyone is watching everyone else, and When one person sells, 5 more follow. And it's also why media plays such a big role. Headlines trigger emotional reaction, algorithms feature more of the same content, and before you know it, your entire feed is screaming recession, collapse, and doom. But here's what experienced investors do. They zoom out. They don't make emotional decisions in emotional moments. They know the best opportunities often come wrapped in fear and uncertainty. They also understand something called as loss aversion. The pain of losing money feels stronger than the joy of gaining. That's why crashes hit so hard, even when you're still up over 5 years. Understanding these mental traps help you to resist them. Number 6. What smart investors do in a crash. They follow a boring, consistent plan, and that plan looks like this. Number 1. Keep investing, especially when the prices are down. If your dollar cost averaging putting the same amount every month, you're actually getting more value for your money during a downturn. Number 2. Focus on quality assets. This isn't the time to gamble or hype stocks or coins. Look at broad index funds, dividend-paying stocks, and companies with strong cash flow. Think long-term stability and not short-term hype. Number 3. Stretching your base. That means building or boosting your emergency fund, cutting unnecessary spending, and increasing your income if possible. The goal isn't just to survive the crash, it's to come out stronger. And number 4, automate your strategy. Remove emotion from the process and set up automatic investments so you don't have to think about where is the right time. Time in the market beats timing the market always. Number 5, stay off the emotional roller coaster. Don't check your portfolio every day. Don't obsess over the news. Protect your focus. Your job is to think over 10 years ahead and not 10 minutes. Number 7, what happens if you do nothing? Let talk stakes. If you ignore this, if you panic or freeze, here's what you're likely to experience. You sell low, you wait too long to get back in, you miss the rebound, you lose confidence in investing altogether. 10 years from now, you look back and realize that fear cost you thousands, maybe hundreds of thousands of dollars. Now, there's the real cause of inaction. Not just losing money, but losing time. Because time is one thing you don't get back. Every crash is a test, and most people fail. Not because they don't know what to do, but because they don't do it. You're here watching this video, which means you're already ahead. You're thinking, you're learning. Now the next step is action. Number 8, what should you do today? Take 5 minutes today and do this. Look at your current investments. If you're diversified and long-term focus, do nothing. If you have been waiting to buy the dip, set a recurring investment today. And if you're feeling overwhelmed, pause, but don't sell. Just sleep on it. And if you haven't started investing, this is your chance, not when the prices are at the top, but when they are down. Recession creates millionaires because they reveal who can think clearly when others can't. The market is crashing, that part is real, but how you respond, that's the part that decides everything. You can give into fear and follow the crowd, or you can take a breath, zoom out, and see what this moment really is. Chance to invest while prices are low when most people are looking the other way. If this video helped you to understand what is really going on, let me know in the comments and tell me what you're doing differently now. Buying more or holding steady or cutting distractions. And if you know someone who's panicking, send them this video. It might be the calm they need. Thanks for watching and stay focused, stay steady, and I will see you in the next video.